Hey, this feels really weird sitting on the kitchen counter, but the living room is an absolute tip at the moment. So yeah, I'm going to address a thing which I hear a lot. And it's basically ignorant people on the internet saying, oh, you can't predict the markets, blah, blah, blah. And I'm here to tell you that you fundamentally, categorically can. I'm not Mystic Meg, I don't have a crystal ball which can predict the lottery numbers, etc. It's not like that. The way economists look at the world is inherently flawed. There's lots of different types of ways to look at economics in the world, and what every economist and pretty much banker has been taught through university and college is a thing called Keynesian Economics, which is flawed. We've got 60 years proof that it just doesn't work. And there's all sorts of models which come with their Keynesian economics, things like VAR, value at risk, which is one of the reasons why every bank and central bank was asleep at the helm during 2001, 2008, and that they didn't see these crashes. There's a term called a Six Sigma event. And the 2008 crash was a Six Sigma event. So thanks to Cora, so a Six Sigma event is twice in a billion event. So what, one in 500 million. And it goes down to what, a 4.5 Sigma event, which is once in 4 million. Now, so we're having all of these events. So the 2001 crash, the 2008 crash, the 2011 flash crash, all of these are sort of 4 Sigma plus events. So, I mean, that's one, so these models are inherently flawed. Now, there's a great guy called Jim Rickards, and he's written 3 awesome books. I agree with a lot that he has to say, and basically you have to use a thing called complexity theory when you're looking at the markets. And long story short, complexity theory is basically likens the markets to weather, and it's so true. So with the weather, I have no idea. In fact, it would be near impossible for me to say what the weather will be like in Florida in 29 years' time. It just can't happen. However, what we can say is if there is a huge hurricane forming, off the coast of Florida, or, in Hurricane Alley, so to speak, and it's forming and you can see that this hurricane is slowly tracking towards Florida, it's then fair to say that this hurricane is going to hit Florida within a certain period of time. That's not predicting the future, so to speak. What you're doing is you're extrapolating what may happen due to data that you have. And the markets are exactly the same. You can see some huge, fundamental, massive trends going on behind the scenes, which the public are completely oblivious, and it's basically just a huge hurricane going towards a certain market, whether a stock market, a company, or currency market, or bond market, whatever. So as an investor and also a trader, all I'm doing is I'm looking at the huge fundamental trends which are very hard to just reverse or move, and I'm simply seeing where it may go, just like when Hurricane Katrina or Hurricane Bob or whatever is heading towards an island, etc. So that is how you can effectively forecast what may happen within a shorter time period. But do I know what's going to happen in 90 years' time? No, not even in 10 years' time. So hopefully that makes some sort of sense. Cheers. 2016 wasn't a freak year. I've read some articles by a mathematician who said that 2016 was a freak year, but I disagree, to be honest.